Copper in FY08 was 8% escalation and 23% drop next year, and 5% escalation FY10 and 33% increase in FY11. Lead 1 or 2% increment in FY08 and 41% drop in FY09 and 20% in 10 and 12% in 2011. And rubber, we can see 8% increment in FY08 and 16% drop in FY09 and subsequently 5% drop and 59% increase in the year FY 2011 in terms of the average prices. I'm not talking about the range, it is the average prices. And steel, 24% increment in 08, 18%, minus 17% and 14% subsequently. Do you put these kind of numbers in your budgets as an escalation or as a saving? Double digits? Mostly we will not. Okay, mostly we will not. So what I am saying is, the way the markets are moving, they might not be in alignment with your budgets. They might not be in alignment with your budgets. That is why you will have one excellent year where you will feel you have saved money, but market has fallen and you will think that you have saved. 1 year you will have so much of escalations. Okay, you will continue to see 10 different heads. How do I accommodate? And you will go back to the management, and then you will try to increase your end product pricing. Okay, so these fluctuations and the fluctuations in our own blood pressure levels, okay, are reflective of the market, and what market is this at the, these are at the average levels. If you go and see the absolute price levels, you will have more worrying facts. So budgeting based on previous year's inflationary trends might lead to huge underestimation majority of times, and few times overestimation as well. Budget linked to commodity price behavior is more closer. So you please understand what are the underlying fundamental factors that are influencing the commodity price, what are the technical factors, what is happening at the economy, and what is the realistic expected price movement in each particular commodity. You have to estimate your budget escalation based on what we call as mapping the market thought. Mapping the market thought means what is the demand supply situations of the underlying commodities and how technical factors are impacting, rather than trying to see what is our WPI and what was my last year purchase price, okay, which will give you some kind of a bird's eye view. I'm not denying that one, okay, I'm not denying that one. Because of these huge fluctuations that we have seen, we have seen over a period of last 5 years, I am saying that old method of taking your last year purchase price and then adding some inflation to it will not work, or is not working already. This slide we have seen how robust and scientific is your budgeting exercise. Okay, the NPM or margins are planned based on the overall budgets, and then you make a budget like this. So you will do sensitivity analysis, 1% savings on this raw material expenses, how much it is impacting your budget. Most of the heads are predictable, as I said. Okay, and the most importantly, are you doing mark to market of budgets, and do you know what is your BEP budget? Okay, when I say mark to market, that is based on today's price how your budgets are. Okay, what is your status? Okay, are you doing the mark to market regularly? Question number 1. Question number 2 is, when I say BEP budget, that is break even point of your budget. What is that? Let's have one simple example. Okay, this is a simple spreadsheet. Okay, here on a particular day at the starting of the year, that is on 31st March 2012, the copper, I have just taken one example as copper as a commodity. The budgeted quantity is 100 and budgeted price is 5 lakh rupees per ton. Okay, budgeted price is 5 lakh rupees per ton and budgeted quantity is 100. So you are saying your budgeted value is 5 crores. Okay, and the current market price as on that day hypothetically is also 5 lakh rupees. Okay, so as you move on from this 31st March towards say 15th June, okay, you have not yet covered any quantities. Your budgeted quantities are still cement 100 and 5 crores budget is there. But the price has increased from 5 lakh rupees to 5 lakh 50,000 rupees. Okay, so what does your mark to market is say? Your budgeted quantities are 100 tons and 5 lakh rupees per ton is your budgeted price. And so budgeted value is 5 crores. And after a certain time period, the price of copper has increased from 5 lakh rupees to 5 lakh 50,000 rupees. Okay, 5 lakhs to 5,50,000 rupees. So what does it mean? Your mark to market P&L with reference to a budget is minus half crore. Okay, the calculation is simple. You instead of you multiply 100 tons into your current market price, which is 5,50,000. Okay, in that minus 100 tons into your budgeted price, which is 5 lakhs. Okay, so 5.5 crores minus 5 crores is giving you minus half crore as a negative thing. Okay, so your mark to market P&L as on that date is minus half crores. So similarly, you will have so many raw materials within your cost basket. Okay, you have to have a mechanism where you track the mark to market on a daily basis. Okay, if not on a daily basis, maybe on a weekly basis. You should have some kind of a system or a spreadsheet where you do mark to market tracking of your budgets. Right. Now, so what do I do? Yes, I understand that today my mark to market P&L is minus half crore. Obviously, the price falls from 5,50,000 back to 4,50,000. My mark to market will be in profit. Okay, it is only an indicator which is telling that if you take a decision based on today's price, how your P&L, realized P&L is going to look like. Okay, if I take a decision today, I am going to make half crore loss vis-a-vis my budget. Okay. If the price falls to 4,50,000 rupees and I take a decision on that day, I am going to say another half crore, okay, or 50 lakh rupees on my budget. Clear, sir? This mark to market. Okay. So what I am saying is, please maintain a track of your mark to market. Next, for example, in this example, here you have decided that based on various analysis and perspectives, you have decided that out of 100 tons budgeted quantity, you will buy 50%. Okay, you will buy 50%. So it means, as compared to your budget, your realized P&L with reference to your budget is now you have realized 25 lakhs loss. Minus 2.5 crores, you have minus 0.25 crores, which is 25 lakhs. You have realized and then you have made that decision. Okay. So now, for any of your budget calculation, you have already exceeded your budget by 25 lakhs. Now, what am I saying then? Then you calculate something called BEP budget, break-even point of budget. What does that mean? Budget, BEP budget is the unit price at which you have to procure the remaining quantities in the budgeted period to meet your budgeted value target. Meaning, if you buy the remaining 50 tons at this price of 5,50,000, okay, this minus 0.25 crores also will be minus 0.25 crores also will be set off, and you will be able to finish your meet your budget. Okay, so at this point of time, after booking this particular loss of 0.25 crores or 25 lakhs, you are saying that if I buy the remaining quantities at a particular price, which is this calculated price, BEP budget price, which is 5,50,000 rupees, you will be able to meet your budget. So whenever that price comes, in the purchase manager's mind, that BEP budget, the break-even point of my budgeted price, okay, it should be there in my mind. Whenever this 550 rupees per kg will come, if I take a decision, I am going to net off and I am going to meet my budget. Okay. So these two metrics are very, very important. One is these two mark to market. Okay, and during the year you calculate a price of each commodity, which will give you break-even of your budget. Okay, so both are very simple. You just mark to market is based on today's price, how your budget is looking like, and BEP budget is the price at which you have to buy the remaining quantities in your portfolio, okay, to meet your budgets. Yes. This number 450. Yes, I have taken only the 50 quantities. Yes, it should be 450. Sorry for that. Okay, it should be 450. What am I saying is, currently market price is 550. If the price falls to 450 and you buy the remaining 50 tons at that 450 rupees, you will be able to meet your budget. Okay. So what should be there in your mind is 450. Okay. Once after a month or two, when the market price comes to 450, what you have to do, you know that's there in our mind and that's there in our spreadsheets every day or on our dashboard. The moment your BEP budget price comes, you have to act. Okay, you have to act. Okay, because what happens after that you don't want to worry. Okay, or you might decide, say that okay, out of the remaining 50 tons, I will procure 30 tons or 40 tons and leave 10 tons for further, bettering the budget. Okay, so mark to market, BEP budget, mark to market, BEP budget. These two metrics are very, very important. Okay. So in the previous slide, we have seen there are 5 metrics that 5 points that you have to follow, and these are the 6th and 7th points. Okay. 6th and 7th points in terms of the metrics you have to follow. Now, having said that thing, okay, so I thought we will start this in terms of what are the practical metrics that you need to track to identify the problem statement that we have done. Now let's look a bit about the industry, okay, how the industry is moving in terms of the commodities as well as the auto industry. Volatility in key commodity markets, these are average volatilities we have seen, okay. These are the volatilities say in copper prices. The annualized volatility is ranging between 30 to 40% here. In the first graph, in various years, these are various years. In various years, what is the annualized volatility is what we are representing here. Like for example, annualized volatility in rubber as compared to copper is relatively less. Okay, annualized volatility in rubber is around 20%. Okay, this is average volatility, means the volatility would have actually fluctuated like this. Okay, like from January 2006 to January 2012, how volatility has fluctuated, the annualized volatility has fluctuated. Like in January 2009, we have seen highest volatility. Okay, highest volatility. This copper has touched 75% annualized volatility, and aluminium 50%, and natural rubber around 42%. Okay, these are the highest volatilities that we have seen, and subsequently these volatilities have fallen over a period of time. This is during the peak of the Lehman Brothers, when there was a financial crisis. The volatilities were very high. Okay, do you track volatility, or do you track only absolute price? Okay, this is again one more question. Okay, we need to track volatility because that is what is going to create problems for you. Okay, it is not the absolute price, because once you factor that absolute price, if your sales realization is a bit higher than that, you don't mind. Okay, what is problem is you factor certain price and that gets haywire because of the volatility. Okay, or you take a decision when market is below the averages levels. Okay, or when the market is above the average level, depending whether we are a buyer or seller. Okay, so this volatility is a major problem. So the point number 8 is please track volatility in terms of the metrics. Okay, this volatility is for various commodities. Whatever is your commodity, there is certain simple statistical calculation to calculate volatility that you have to implement. Okay, or you should have a system which calculates all this. Okay, now when I average that seesaw graph is what I have represented here. Okay, so for aluminium, the annualized volatility on an average basis is between 25, is around 25%, and for steel, annualized average is around 22%, and for lead, it is a bit higher, around 35%, and this is for Dow Jones UBS commodity index. But after taking multiple commodities, Dow Jones and UBS have a commodity index, and the volatility for that is around 17%, because they take some 17 different commodities. Okay, so what is the volatility index for your portfolio? The way Dow Jones and UBS has 17 commodities based on their own criteria for trading, you will also have a basket of commodities. Okay, so based on the value, okay, so if you are talking about 500 crore portfolio that you are managing, out of that there are 4 components. One commodity is giving you 250, it means it is having 50% weightage in your portfolio. The other commodity is having say 100, it means it is having 20% weightage. So based on the value of the total portfolio, give weightages to the commodities and track your index, your commodity index for your portfolio. Once you track say your index, where is it, whether it has increased or decreased, because you are a boss, you are a head of sourcing, or the senior person in charge for sourcing. Okay, and there are 3-4 commodities. Okay, so sometimes you will have compensating effect. Okay, one commodity will rise, one commodity will fall. One commodity will rise and one commodity will fall. Okay, so when after the net effect of this particular thing, what is your volatility? What is your commodity index increment? Please track that one. Number one. Number two, what is the volatility on your index? Again, you have to track whether you are dealing with a set of commodities which are having 20% volatility in a year or 40% volatility. Based on that, you have to decide what kind of attention and what kind of framework and people and resources that you should have in place. Okay, if you are dealing with less volatile commodities, the way you have to pay attention is different. Okay, if you are dealing with high volatile commodities, the way you have to pay attention is different. Okay, and definitely there are for each thing, even if it is a single product, like say for example tires or batteries, you will be using multiple raw materials. You will be using for tires, for example, natural rubber, carbon black, and then nylon tire cord. And so the crude oil price movements as well as natural rubber price movements for synthetic rubber will impact your index. Okay, you may please make your own tire index. Okay, say with consisting of 5 components. Similarly for battery, what are your commodities, and for alloys, what are your commodities. For OEMs, obviously there will be a bigger set of commodities, mainly with base metals like aluminum, copper, lead, and then natural rubber and polymers. Okay, being the larger, and steel. Steel. So these 6 commodities are the larger base. Okay, so these commodities contribution in value terms to the total portfolio. Please make an index, and you track your index on a day-to-day basis. You track mark to market of your index as well as each commodity thing on a day-to-day basis. Okay, and this all you have to set up the process one time. Every day you get the report automatically, either from a spreadsheet or from a system. Okay, and then you track volatilities of that. Okay, is what we are trying to say. These are market volatilities of various commodities, and this is for Dow Jones US commodity index. Okay, why the volatility has been increasing in the market over a period of time? The reason is commodities are emerging as an asset class. What do we mean by asset class? Money is an asset. Okay, a particular real estate property is an asset. Why? Because it is having a definitive value. Means money, total money supply in the market is limited, and there is one number which you can put how much money is there in the market today. Okay, the commodities have, we used to think that commodities are perennial. How much commodity is available in the market, okay, was perennial. It was not, there was no definitive number. Okay, for example, I am talking about an agriculture commodity like soybean. Okay, you can produce as much of soybean as you want continuously over a period of time. Okay, so it was not very definitive. It was not definitive initially. Okay, so later at some point of time, when people estimated that we are having crude oil, which is your petroleum resources, restricted, and if you dig all of them and use them, you will have results only up to 25 years. Somebody made this statement. It means from a perennial source, it has become a definitive source. When it becomes definitive source, it becomes an asset. Okay. Then people start saying that the terminal value of the total crude oil market is X. I discounted. Okay. I discount the terminal value to present value today using a DCF method or whatever method. Okay. So I want to assign a price to it. If my discounted cash flow price is lower than the current market price, then I will buy, or vice versa, basically, or vice versa. So what are you trying to say? The commodities have become has emerged as an asset class. With this thing, apart from the sellers and buyers in the commodities, the funds or the hedge funds started investing money and seeing that means they started trading on this. Okay, I buy copper and then I sell it after a year or two. If the price increases, I make money out of it. Similar to your equity instrument. So you have various asset classes in the market like equities, bonds, currencies, commodities. Okay, like that there are 6 asset classes. So once the commodity has become an asset class, the interlinkages with the other asset classes like equities, bonds and currencies have significantly increased. Okay, that is why today if there is a stronger dollar, what will happen to our commodities? Commodities will fall. If there is a weak dollar as against the other currencies, commodities will rise. Okay, so the moment you see a fluctuation in dollar vis-a-vis euro or vis-a-vis other currencies, you will see fluctuation in your commodity prices. So in the last 10 years, commodities have become an asset class. So apart from you and me, means though I am not a player in the market, but you are the player in the market. Apart from buyers and sellers, the third person also has come into thing who is an investor into commodities. Okay, so the interlinkages of what buyer does, seller does, and investor does is what is defining the market. An investor is a very, very, very large community. Okay, the whole world. Okay, there are less number of buyers and sellers and more number of investors in the market. Okay, why? Because we are also, as an individual, we are also an investor. You would be investing in equities with your own monies, and sometimes you would be investing in, if you want, natural resources fund. There will be one fund which will invest on natural resources, who will go and buy the stocks of companies who are producing copper, who are producing aluminium, who are producing palm oil, who are producing natural rubber. Okay, these are all natural resources. So I invest a lakh rupees in this index, in this fund, and that fund goes and trades in the market. Okay, that will bring in volatility. So at home I invest 1 lakh rupees, I go to office, and then that fellow will become your counterparty. Okay, and that at office when I go to buy these commodities or sell these commodities, that fellow will become the counterparty. So this phenomenon of commodities emerging as an asset class has resulted in incessant money flow and decreasing value of money against commodities. The result is higher volatilities and trending markets. Okay, I am an investor, I do some analysis and then I keep buying. I have deep pockets. Okay, I don't care. I have deep pockets. That is why all your life, okay, in 20 years of experience, 15 years of experience that you have seen, at some point of time you would have been in a position, this is the demand, this is the supply, so mostly the price should be this. Okay, you are going right, all of you, very with rich experience, you are going right. At some point of time, for the same kind of ending stocks, you have completely 100% different price. For the same kind of ending stocks in copper, you have seen 50% in different price. So why? Mainly because this element of investors have come and commodities are emerged as an asset class. Okay. So that is why we call price is a function of demand, supply, and an element of expectations. What we call as E element, expectations. Expectations of investors and perceptions of investors as well as the buyers and sellers. Okay. Now we will have more detailed discussion on that in the post-lunch session. Okay. So this is how the industry is coming in, and this was covered. Okay. And here we have seen, okay, this is the LME copper average traded volume over a period of 3 years, how the traded volume has increased from 45,401 tons. Okay, the traded volume has increased to 75,102 tons. Okay. At the end of the discussion, when Rashmi makes the presentation about MCX, she will also be showing this graph. Okay, there is a huge volume increase in terms of trading. Meaning the same commodity 1 ton is being traded multiple times. Okay, because of that we are seeing this kind of a volume increase. Okay, and that's why even in MCX also we have seen these volumes increasing. And this is the daily LME copper average high low. If you have a high price for various days, you have a high price, and for various days you have a low price. I take the average of these highs and average of these lows, okay, and so that will give me average range per day. Okay, if I take average of highs and average of lows, okay, what do I get? I get average range per day. The average range, which was $383 in 2009, okay, in a day, the average range, that has got to $520 in the year 2011. Means within the day, how much the average fluctuates. So, higher the traded volume, more and more people are hedging and trading and investing. Okay. Yes, please.
So whatever you are showing the traded volume, service the consumption, what could be the ratio rate? Say if I actually consume one
generally, if you see in LM, Sunil, you have a number 8 times, it can go up to 20 to 50 times of the actual consumption. Meaning 20 times you are trading than consumption. Rashmi, have any number?
Oh. The trading can happen on MCX. I can give you an MCX number. Typically, I mean, if you say look at copper, right, the annual capacity in India, look at the entire business, I think it would be about 2.5 lakh to 3 lakh tons overall. And we do a business of about 8,000 crores in a single day. So it's almost at about, the whole of the day we manage to trade the entire number that is produced.
So she's talking about around 200.
Depends on commodity to commodity.
So each commodity will vary. Copper, because the trading is really high, consumption is higher, so it's it moves that way. Like on say aluminum, you see highest traded contract of London Metal Exchange. Okay, the consumption and the trading volume on LME aluminum is almost 70 to 80 times of what the actual consumption is. I'm saying the world consumption. So 70 to 80 times of that volume gets traded on London Metal Exchange, and this could sometimes happen so investor class is so large that that sometimes it overshadows the real players.
Okay. So the answer is depending upon the commodity and which market, it ranges from 3 times of your consumption to as high as 200 times. Okay. As high as 200 times. This we should not be looking at only at the country level, we should look at the global level. Global consumption of commodity versus global traded volumes. Okay. So because there are multiple exchanges in multiple countries, it can be as low as 3 to 4 times and it can be as high as 200 times as well. Okay. So with this thing, what is happening is the same pen is being traded multiple times, and that is what the industry trades. Is it bad for us? Is it good for us? Yeah, it need not be bad. It increases volatility, but it also gives you opportunity to hedge. Okay, you have a BEP budget of 4,50,000 rupees or 450 rupees. After that, what happens? I don't care. I want to pass on the risk. I want to fix my price at that level. For you to do that particular thing, there should be opposite party who will do the transaction. You call your supplier and say that today market price is 450. I want to fix it for the whole year. How many suppliers will say yes? You have a practical problem. You don't have a counterparty. You want to do a transaction. You want to make your life simple. You want to make money from your engineering and branding of your products. Okay. You don't want to make money here. So I made a budget, and today market price is at my budget price. I want to call all my suppliers and say that, boss, you fix it for the whole year. That's it, done. Overall story. After that, whatever happens, I don't care. Somebody might be making more money by selling on the budget, or somebody might escalate. I don't care from my business point of view. Do you get a counterparty? You don't get a counterparty. This problem is called liquidity. Okay. Liquidity means the price at which you want to transact. If you are having a counterparty, easily available without impacting the price. 450 rupees, 450 rupees. You want to do 10,000 tons or 1 lakh tons, the counterparty should be available. Without impacting the price, if you are getting the counterparty, you call this as a good liquid market. Today, without these futures markets, without all these volumes that are traded from 5 times to 200 times, okay, you don't have the liquidity. That is why you are unable to, you will see, on the face of it, you will see one day you are happy at office saying that, if this price stays, I am going to better my budget by 5%. But you cannot fix the prices that day because of what? Liquidity problem. That is why always it is not necessary that the increased volumes in the exchanges are bad for us. They are good for us. Why? Because it is giving you liquidity and it is giving you counterpart. Okay. But because of the framework with which we have emerged over a period of time, we think that